Hello, everyone, and welcome back to what is certifiably a very special episode of the Property Trio, because I'm joined by my normal interlocutors, but today we've got the man that puts the gent in gentrification, the professor himself, Peter Kalisos. Welcome back.
Thank you very much, Mike. That's a wonderful introduction there. It's great to be back on the podcast. Everyone's looking really good in the new year. But it's a pleasure to be back and wonderful to be invited back.
So
good to have the band back together, Pete.
Great to have you back, Pete.
I worried about...
Is Mike Ringo Starr?
Yeah. The drummer. Keeps the beat going.
Oh, yeah. Sorry, it's a generation thing here. You may not have got that. Sorry, Mike. Yeah.
We're not calling you Yoko Ono. It's good, Mike.
I am young. No, I was petrified about the shoes I had to fill, but I just decided to push them to the side, take my own off, like open homes in Perth at the moment. And that is probably a good segue, because obviously we know some of the markets that have done an amazing job in 2023, such as Perth. And spoiler alert, somebody had a little bit of a sniff at Perth back in... This must have been January 2023. So today's episode is looking at the predictions that you guys made last year. Thankfully, I wasn't part of it, so I can sort of, throw shade at anybody that gets it wrong. It'll be my term next year. But, moving into the start of 2023, the world was a little bit different. Obviously, we were post-pandemic, but for me, what stands out is that no one really sort of anticipated inflation to be such as it was. Cast your mind back, guys, and maybe start with you, Pete. What were you kind of thinking in January 2023?
Well, I thought that almost the worst of it was over, so far as interest rates were concerned, and therefore inflation, but it obviously wasn't. Now, I didn't necessarily feel that personally, because I'm at the other end of the investment journey, but three of my children got mortgages in the last 12 months. And so, what they were originally paying is very different to what they were paying now. And so they certainly felt it. One of them had to get a housemate because she couldn't afford to pay the mortgage on her own. The other one, and this is a blessing in disguise, had to come up with a budget. Imagine that, a millennial with a budget.
No more smashed Avo, Pete.
It was quite a shock for interest rates and inflation to keep going up. And it's probably no surprise that inflation is coming down much quicker than they expected as well.
Now, let's dive into the first of the predictions, because we've got quite a few to cover off today. And we'll start with Cate. Your prediction, we'll see a bounce back when rate of increase of cash rates stops. A bit of a flex in the interest rate due to competitive conditions, regulated to have a tighter buffer than 3%. So definitely a bounce back. And I suppose that echoes Pete's prediction as well. Nationally, property prices will be higher at the end of the year. We'll give him a big tick for that, mainly because interest rates will be lower. So that's... Yeah, so it's sort of like, well, he got it right, but perhaps not for exactly the right reason. So, Cate, how do you score yourself on that first prediction?
I was pretty bullish that we'd see the buffer rate decrease, and I thought that competition between banks would be palpable, and I was right there. But I thought the regulators would let the banks reduce the buffer rate from 3 to 2.5 again, because I think it's abundantly clear that we're towards the top of the cycle, if not at it. And that's been the general consensus, and it's been, in the minutes as well. But no, that didn't happen. And it just goes to show, regulation's regulation. And the fact that the interest rate increases have been hurting that contingent of borrowers is not enough for the RBA to suggest that, that's something that, or for APRA to suggest that's something they'd agree to.
And just because they didn't do it doesn't mean it wouldn't have been a good idea, right? Because now with the buffer such as it is and interest rates, we're fairly confident we're right up there, if not finished increases. I think the economists are predicting the next move to be a hold, and we're probably coming down from there quite rapidly, one would think.
I think so. The hardest thing about increasing interest rates is the cohort that you really hurt are those with a mortgage. And we have to remember that 2/3 of Australians don't have a mortgage.
Mm.
You know, you've got a third that have a mortgage, a third that have paid it off, and a third that rent. That's how it goes. So, you know, all of the retirees and people that have paid off their home, these increases haven't hurt them. In fact, someone with cash in the bank would be, you know, skipping and singing. So I thought that might have been something that would ease.
Now, Dave, this one's going to sting. And you know, in fairness to you, Dave, you did get quite a lot of this right. But your prediction: prices will drop by 5 to 8%, mostly in the first half of the year, and it'll turn in the second half. Now, I think it probably did turn more in the second half, but the drop, cast us back to your mindset for the drop.
Well, look, I just that talked about countries being invaded. So
yes. He was worried about the Ukraine and Taiwan, and you know, Taiwan has now got this new leader that's given basically Xi Jinping the middle finger on day one. So that could really, you know, you might just got your timing wrong, Dave.
Well, they reckon he's told the what are they called, the People's Liberation Army, to be prepared to invade Taiwan by 2027. But so the US intelligence suggests, but. Yeah, look, I mean, basically, I didn't think our property buyers would be resilient, and as resilient as they were to interest rate rises. I was pretty confident that, you know, most of the rate rises would be done in the first half of the year, but there was that one shot across the bow in November by the RBA, but there was 4 in the first half of the year. So, you know, I think a lot of people have been surprised by how resilient prices have been over the years. So, yeah, I certainly got that one wrong, predicting minus 5 to 8% for the year. And, yeah, the other two got it right.
Well, what I admire is that you went for it, right? You didn't say, oh, I think it'll drop. You gave a very specific mark. And, you know, sometimes that's a bit of a Hail Mary. And to not sort of rub your face in it too much. Like, think about every bank economist at the start of COVID, right? So, you know, like you got it wrong a lot less than they did, and that's their job to get it right, Dave. So, no, like as much as I was looking forward to that one, I'm giving you a soft landing.
Thanks, mate. Very generous of you.
Now, capital city top performers. This is where I think you guys probably excelled fairly well across the board. Cate, Pete, and Dave, all three of you really highlighted Perth as having a run in 2023. And look at the results, annually up 15.2%. So, you know, a round of metaphorical applause for all of you for that one. Cate, you were saying
one of those buttons that does the applause, Mike.
There we go.
Oh, there we go.
There we go.
I thought you would.
I'm here all week. Yeah, I've got tech. So, Cate, you were saying Perth could have a few surprises in store, and Melbourne to bounce back because it was underdone with extended lockdowns. Decent bounce back because of new arrivals, rental and sales data as well. So Melbourne was definitely did have a bounce back, but
I wouldn't call it. I think it was resilient. You know, someone wrote resilient in terms of the headwinds that we faced. When we did these predictions, we didn't know that land tax was on the agenda. And we didn't know that we'd have, you know, some of the outcomes that we've had from that. So I would prefer to say I didn't get that right. You know, Melbourne bouncing back is not, I didn't have 3.5% in mind. I actually thought Melbourne would do it. Brisbane did. If anything, we've all missed Brisbane. Brisbane did 13.1%. And we probably all thought Brisbane had such a good run. And, you know, there's such a different blend of houses and units there. We had various reasons for not backing Brisbane. And, you know, the one that's really consistently performed has been Adelaide. And Dave and I don't think touched on Adelaide. So, yeah, we nailed Perth, but I think I was optimistic about Melbourne, and I didn't anticipate added headwinds to the already, you know, horrible trifecta of challenges we had through COVID.
I think in some respects you did predict some intervention from governments. I think there were at least one of you predicted perhaps some incentives for investors, and that again, that probably is what should have happened. It's the opposite of what happened, and I think that's why Victoria is in the in the situation it's in, and I expect it to probably be in the toilet for 2024, which is a sad state of affairs.
Good rents, though.
Yes.
Rents,
yeah, absolutely.
yeah.
Nailed rents.
A bit
Give
of
you full
saving
marks on that.
grace.
Pete, you said Sydney and Perth to be the best performers for 2023. So you got first and third position. So I'd be pretty happy with that, to be honest. Like looking forward next year.
Yeah.
Be a high distinction, but that would be a distinction. Right? 2 out of 3. Brisbane, I think, will continue to do well. You've got interstate migration, mainly from New South Wales, continued infrastructure build for the upcoming Olympics. So I can see Brisbane continuing on its strong run, and Adelaide, and Perth. I mean, you're all in the eastern states, so you probably know better than I do. But when I was at the Pippa conference late last year, I spoke to a number of eastern states buyers agencies, and a lot of them were buying in Perth, and not necessarily because they thought it was going to be a great city to buy in, but that's basically where a lot of their clients could afford to buy a house. Median price in Perth is one of the lowest in the country, and with interest rates so high, it was very hard for most people to be able to buy in places like Sydney and Melbourne. Adelaide was more expensive than Perth, and Adelaide had a good run from eastern states buyers agencies last year and the year before, and the focus seemed to be on Perth. I spoke to a number of Perth real estate agents, and they're telling me every second or third phone call they get is from the eastern states for an investor looking to purchase a property. And I think that will continue.
Yeah, and that was really born in our data, in our business as well. Perth actually came in second place after Brisbane as the top investment location in Q1 2023, and it was nowhere Q1 2022. So yeah, some interesting comments there, and the trade war between China and Australia calming down, you picked as well. So at one point they said, we don't want your red wine and your lobsters, and I thought, how long could you live without those two staples of the food pyramid? They've got that steely resolve, but once you get some Barossa, Shiraz on your palate, it's hard to stop.
It is, isn't it?
Dave, you agreed with Cate that Melbourne has less room to fall. So it showed some resilience there, and you talked about high overseas migration coming back. You also agreed with Pete on Perth. You said Adelaide had the furthest to fall. Adelaide, we had 8.8%, which normally is massive, but it was a big year, so it was kind of middle of the pack. But you did pick Hobart and Canberra in for a tough year, and they were really last and third last on the list. So Pete gets full marks for the glass half full approach. You get full marks for the glass half empty approach.
I think that's a B for me.
Pretty good.
Maybe a big plus and a push.
Yeah, I definitely got Melbourne wrong, and Adelaide finishing with the furthest to fall wrong as well. So, yeah,
I actually think that was pretty good. Hobart definitely was the underperformer, and you picked that for sure. And in previous episodes, we've been talking on and on about Canberra underperforming. So no, I think you're being a bit hard on yourself. Let's talk about the regions. Kate's predicted that major regions that have a city centre or easy commute will hold firm. She's fearful about the higher priced holiday and coastal markets, and perhaps that fear is something that can be pushed down the street a little bit, right? Because we haven't sort of seen those areas suffer incredibly, but definitely at the higher end of the market.
Yeah, if we have a look at the coastal holiday markets and those that have fallen the hardest, we've certainly seen it in Vic. I mean, that's the data that I focus on.
Yeah.
If anyone has said to me, I want to buy something in Sorrento or Bulgaria, I'd be saying, hold your horses as long as you can.
And I suppose for the reasons that Pete predicted, capital cities will do better than the regions as the memory of COVID-19 diminishes and there's start of a move back to the city. So I suppose it's that disposable income and that holiday of going out to the burbs, and everyone's talking about swinging cats. But the offices are wanting people back in the CBD, right? So yeah. I think you guys both did fairly well on that one. What were your thoughts, Pete, specifically with capital cities outperforming the regions? Was it just you saw it as a big exodus that really wasn't sustainable?
Well, as you just touched on, employers are wanting people back in the office. The reality is they'll have to allow their employees to work from home for some of the time.
Yeah.
But rather than going to the extreme in COVID where you work from home the whole time or most of the time, it'll be now you can work from home some of the time to give their employees flexibility. And so that means even though it might have been lovely to live in, I don't know, Bendigo or Ballarat or maybe the central coast of New South Wales, because you only had to come into Melbourne or Sydney once a week, now that you're going to come into work 3 or 4 times a week, it's a different story. So I think we will continue to see capitals outperform regional areas. One thing that'll hold up regional areas is whilst interest rates are still high, it makes regional property more attractive. It's more affordable for investors to get into. So I'm not going to say regional areas are going to fall away, but I still think you'll see capital cities performing better than regional. But digging deeper into the data, even though bosses are asking their workers to come back to work more, I think office property still has a long way to go down.
Oh, yeah.
As those longer term leases come to an end, there will be less businesses leasing the same space in the future.
Yeah, and you did predict that in a little bit further down in the sheet as well, that the office markets would suffer, but other commercial areas or subgroups would do pretty well, and we've seen evidence of that. Dave, you've got it right in a wrong way for regions, I think. It's just this thing that we're going to have to keep coming back. Combined regions will fall further than capital cities. So, I mean, that's
they rose less.
Yeah. It's going to, like, if we just sort of get AI to tweak that to it'll be better in capitals and worse in the regions, then you've absolutely nailed it.
Yeah, look, I think I need to be vaguer with my predictions.
Yeah. Think of future Dave.
So, yeah, look, I think I was pretty similar to Pete with what I spoke about overseas migration and interstate migration. People will start to move back to the cities, and we've seen that happen in 2023, particularly that intrastate, go back to the same sort of numbers as we had prior to COVID. I also spoke about the work from home phenomenon is probably here to stay, but I thought we'd see profits fall for companies and tough times in the share market, which was it wasn't that tough in the share market. It was flat in Australia, but then it rose again in the last month of the year. And I said that people working in the office will become a higher sought after commodity. And I think that's just still in the early stages of occurring. I think that's actually going to increase further in the next year or two, particularly as unemployment continues to rise.
Now, getting to investor numbers, you were all very much on the same page. Cate said numbers will stay similar. Pete said they'll remain the same because I can't see any property investor incentives on the horizon. I think there's a fairly strong argument that we would need some to undo this rental crisis, but you nailed that one. And Dave saying that it'll be broadly similar, but the government will strive to make it easier for renters and first home buyers. I think we've definitely seen plenty of evidence of that, and probably more to come as we head into some state elections and some, we're already sort of on the campaign trail for the next federal election, which is horrifying to think we've got to sit through so much of it. But you look at the numbers, the investor versus owner occupier, those are sort of hard percentages to move because they're so big, but they've stayed flat for a long, long time, like really all of 2023. It's there or thereabouts, right?
We've had a very recent kind of uptick in investor activity. It's not been as massive as some of the charts would have us believe when they cherry pick data, but I saw a report only yesterday that investors are pushing first home buyers out of the market, which is just ridiculous. But we've had a slight uptick in investor activity, and I think the one thing that we probably underestimated was the the lure of higher rents. So despite the fact that holding costs are much higher, investors are seeing opportunity. And maybe that's because it's an alternative to the share market and they're cautious. But I didn't anticipate that small uptick. I really thought it would be quite a flat line.
Yeah, and if you look at when that occurred, it was in the back half of the year. It sort of jumped from being in the 33%, and then it jumped up to in the 35s in June, and then sort of stayed around that mark. Actually, November, which is the latest stats we have, is the same as June. So it hasn't really, it did bump up, but then it came back down again in November.
Our challenge there is lack of visibility. Unfortunately, that ABS data is lagging by about 3 or 4 months for us and for everyone. So we haven't got a super reliable dashboard, but it certainly leads us to another topic, which is lender appetite and credit policy. That's been really healthy for investors, and banks are hungry. So, yeah, interesting that we haven't seen any silly policies outside of what we've already lamented about that have driven investors away from a credit point of view.
Well, it is only January.
Silly days.
So, Pete, you couldn't see any investor incentives on the horizon, but would you expected investor disincentives? Because I would say we had quite a lot of them in 2023. We had the Queensland land tax, which was ultimately repealed, but not because they thought it was a bad idea, only because the states wouldn't give them the data. There's obviously lots of rhetoric around rent caps coming from the Greens, and Victoria with their land tax changes, and on top of the changes to the Tenancy Act, the minimum standards. There's actually a lot more disincentive to invest in property now than there was at the start of 2023. Did you expect that to happen?
What I saw it happening at the beginning of the year with a lot of the investors that I knew, they were just selling up. In South Australia, our land tax changed as well, where the Revenue Office didn't care whose name the property was in, but if you were a director of the company and you owned one in person and you and your wife owned one, well, it's the same ownership. And so it was all aggregated together. So for those people that had multiple investment properties, their land tax bill went through the roof, and a number of them have started selling. And if you're, my age, if you're in your 50s or your 60s, and I can tell you from experience, it's something that should be seriously looked at, and that is selling your property and putting that profit into super. I mean, you wouldn't do it in your 20s and 30s because you're not going to benefit from super for many, many years. But as you're getting closer to 60, that is a really good strategy. That's certainly what I've done. I've sold 2 in the last 2 years and did that. And I'm selling another 2 this month. And it's not necessarily because land tax is high or the legislation for renters has changed. But I'm getting to that time of my life where I don't want to get to 85 and still be dealing with tenants or property managers. So super is certainly a great avenue to a great place to be putting your money.
But for those people, sorry, Dave.
I was just going to say, because of the tax breaks in super.
Absolutely.
No land tax.
Yeah.
And for those people,
they keep changing the rules. A lot of us had set up, family trusts and different ownership entities for land tax purposes. Spent a lot of money doing that, and then they changed the rules on land tax.
Yeah.
Well, they're also looking to change the rules on super. So there is no guarantee, but you can only do the best that you can do.
A number of states had already taken that approach with the aggregated ownership. Yeah. So if you owned a property in your personal name, and then you're the director or the trustee of a trust, and then the director of a company, it already got aggregated. So South Australia got on board with that recently.
Yeah, and I suppose getting back to that original point of people selling, for people that were on the fence on maybe we'll sell it and put it into super, maybe we'll hold onto it, those land tax changes may have accelerated that decision, right? And I think all those little things are part of the reason why the rental market is so tight today. Obviously, there's other parts to it. And I was just about to say, yeah, super's good, but how long before they start coming for the super, Pete? Is that a 2024 thing? Is that a May budget announcement lurking for us?
Well, there's already talk about if you've got more than $3 million in your super, they're going to do something. I mean, I don't
Yes.
have that, so I don't take much notice, but they're looking to change that. And the Greens have a lot of power at the moment federally. And, you know, because the Greens are also talking about a rent freeze.
Yeah.
Still. And as you said, you know, it's early times for campaigning for the next federal election. So who knows what changes are ahead. But the big kicker for investors is, especially if you've been in for 4 or 5 years, the growth you've seen in 2020, 21, 2022 means that you've got lots of profit or equity. So it's no problem to sell. You know, it's not like you're going to sell and realize losses. So the fact that everything went well the last few years and now it's getting harder to be a property investor, you throw your hands up in the air and move on.
That is an interesting point because you can see in the data that people have a loss aversion. So they're much less likely to let go of a property that's in negative territory or gone flat. But if they've done well out of it, they're like, oh, look, you know what, we've had enough of this. We've done well. We've made money. We're all good. So I think the policymakers need to take that into consideration. Investors don't need much of a shove to go, this is just a bit too hard, too onerous.
Oh, well, shares are performing and dividends are looking good. It's certainly a consideration for older investors.
Who can put it into super and put large swathes of cash into super as you get closer to retirement.
That's right. I mean, the beauty of property versus shares, and you've said it so many times, Pete, is your ability to leverage. So your return on investment is what's valuable. But once you're, you know, in the later years, the final decades of your investing, property investing, you're not needing to leverage. You're not wanting to leverage. You're actually wanting to retire your debt.
You know, I am the oldest bloke here, but I don't want to, you know, put
Only by a
the other young listeners off. But when you get to a certain age, you know, you don't want to be taking any more risk. Like, I'm not planning on developing anymore. You know, I've been very fortunate that in all the deals that I've done, I haven't lost any money. But the last thing I want to do is the next project I lose money on. Because when it comes to developing, you know, construction is so uncertain at the moment, and Mike would probably know this more than any of us here. You know, the supply of materials is not too bad, but it's just the labour. You know, people just can't get the labour. Prices going up all the time. No, mate, that's the last thing I need.
And labour's not an easy fix either. It's a long lead time to get the apprentices through and get people at a level where it makes a big difference. And yeah, you're absolutely right. Materials have certainly moderated, but then you've also got less competition in the marketplace as well because we've had a lot of liquidations, which is a bit of a sad story.
It's even harder when we can't bring in skilled tradesmen as part of our migration program.
That is an interesting one. That's almost like a whole other episode. But yeah, there are some forces at play that are not wanting this, what they used to call almost like scab labour, right? Where the unions would strike and then they get the buses of these people and throw, you know, tomatoes and eggs at them. We'll put that one to the side. Government intervention in the property market. I really hoped that in 2023 I wasn't talking about that at all because it hadn't happened, but I feel like I've dedicated so many hours to it. Cate's basically prediction was, I don't want to call this wrong. Cate predicted that politicians would act reasonably. And maybe that was your first mistake.
That's silly.
Tight rental stock, we may see investors get a bit of an incentive to get back in. But in economics and politics, they're not always aligned and they don't want to come across as giving investors any favourable treatment. So I think you said what should happen, and then you said why it's probably not going to happen because, you know, like at the beginning you might have come across as cynical, but you actually just nailed it.
Well, yeah, it's not a popular voting platform giving investors a leg up.
Pete said no intervention from the government or APRA as there's no need. There will not be extreme heat in the market in 2023, so nothing for them to cool down. I suppose house prices, they weren't necessarily looking at cooling down, but rents was the big focus, right?
Yeah.
Sure, it was. There is some property research company that said that rents have increased 0% in the last 3 months nationally.
Right.
Now, I did hear before that Melbourne is going nuts. But it must mean that other capital cities are either going backwards or they're stable. I know in Adelaide, rents are still going up. So maybe in Sydney, I mean, because that's the biggest property market. Maybe that's dragging the national
I
figures
actually
down.
think no one really wants to move house close to Christmas.
Mm. Yeah, it
They
could just be
usually drop.
timing.
The fact that they haven't dropped means that we've had underlying pressure, because for them to hold even through Christmas suggests that we've still had vacancy rates really biting and keeping it level, because it always drops off over Christmas.
And Dave, you were talking about I suppose the more positive, palatable government intervention, shared equity schemes, home buyer funds, assisting low-income earners and single parents. And we certainly saw plenty of evidence with that, with the Help to Buy programs and all of the other federal plans that have been announced in the lead up to the next election, and of course in the budget as well, and all of these promises about building 1.2 million homes in 5 years, which I don't think it'd be going out on a limb to say ain't going to happen.
Yeah. I think they've certainly tried to do some good things in the space for like single parents and essential workers, and they've put some positive programs in place there. But look, it's the investor stock that we really need to see coming back on board, don't we?
Yeah, absolutely. All right, so developers and building. Cate suggested that private builders will see the exorbitant price tags coming off a little bit. Everyone needs to work and wants to work. We're not seeing a lot of development activity. Private builders will be hungry for work, but fearful for new build, limited count. We definitely have seen the pipeline of high density residential unit markets coming off. There's a marked decrease in that, because these developments aren't necessarily stacking in a high interest rate environment with a shortage of labour. But give us a bit more detail into what you thought, and I'll even let you score your own scorecard for this one,
Well,
Cate.
I didn't entirely get this right. I know that anyone wanting to do a bespoke renovation or extension, the wait times were just huge and the costs were really high. And I thought that would start to ease and we'd see more renovating. So we'd see less of a discrepancy between renovated properties and unrenovated properties, because as we all know, for the last couple of years, unrenovated properties have not performed. And I would argue that the buying conditions are amazing if someone can land bank or live in a dump for a while and then renovate. I thought that we'd see that two-speed market start to calm down and look more like a traditional market, and see buyers grabbing that old, horrible stock that needs a renovation. But it hasn't happened. And so I'm not going to score myself a win on this. And I think the bit that I overlooked is we have so much work going in civil works across many cities, particularly Melbourne. The big build here is enormous. Everywhere you drive, you're reminded that our city is investing masses of billions of dollars in infrastructure. And that has taken a lot of private tradies out of the private market. And they're really enjoying being a contractor and getting attractive pay and pretty good conditions. And I know anecdotally of people who have done it, my stepson included. So I think until there's less civil work going, we're not going to see the private builders returning in droves and being available for these bespoke builds for a little while.
And the other thing that's happened that's taken away tradies is the natural disasters in Queensland. That's taken a lot of tradies up. And so for those of us either trying to do extensions or do new builds, it's pretty hard to find the labour.
Yeah, I was just about to say that exact same thing. And I've mentioned on the podcast before that my old man said when I was younger, get a trade, son, you'll always be all right. And I'm like, buzz off, Dad, I'm going to university, I'm aiming higher. And I was admiring Pete's certificates behind him earlier, which you can probably see on YouTube. Yeah, not even
They just
not
look
even
like
yours.
you have about 5 there, Pete.
It's all from yours, Pete.
Yeah.
The reality is, the reality is he's probably got a lot more. But the money's in the trades right now, right? And you're absolutely right. The government infrastructure pipeline is massive. There's a fairly strong argument to say, from an inflationary point of view, from a construction labour point of view, it might have been better to hold off on some of that, but there's probably economic models to say the benefits of it. But the natural disasters, I mean, I've spoken to massive volume home builders that have said we can't get roofers because of the cyclones in Queensland. That stuff happens all the time because that's where the money is, the government work and the rectification works. Because I suppose if you think about insurance, if it's uninhabitable, then the insurance company needs to provide alternative accommodation, which every day the expenses tick up and up. So they will pay top dollar to get the trades.
Dead right. Yeah.
So Pete, your idea was that developers or building will slowly recover as the supply chain gets back to normal. And I think you referenced before that definitely has happened, but things like the government pipeline and natural disasters have really impacted that labour. So perhaps that recovery is going to take a little bit longer, do you think?
Yeah, I think so. Yeah, it's not going to happen anytime soon. States all over the country borrowed money when it was really cheap during COVID. And it obviously takes years for major road infrastructure or rail infrastructure to be completed. So that's still going to occur. They're still dealing with the natural disasters on the eastern seaboard. So it's going to take a while for that to get back to normal. I don't think it'll be this year.
And Dave, you were suggesting that prices will recover due to the huge COVID demand. Increases in cost due to supply chain issues will fall this year and possibly significantly. I think you're pretty close on that one. New home builds and home renovations will dry up significantly and larger developments struggle to come online. I think you did pretty well out of that one, Dave. How would you rate yourself?
Yeah, I think I did okay on that one. I don't think it was the hardest one to predict, though, and I think we all sort of said similar things there, and that's the way it's played out.
Well, what a segue into the next one, talking about getting it all right across the board and saying similar things. Interest rates. See, this is where I'm having a great time, and this time next year I'll be slinking back. You'll see it in my posture. It'll be miserable. I hope to see you for that one, Pete.
Right.
So it looks like Cate was agreeing with Pete on this one. So we'll start with Pete. Interest rates will be lower at the end of the year compared to the beginning of the year, mainly because inflation will be lower. Gosh, yeah, that one's
what a disaster.
In
it's
fairness,
a bit like you said with Dave, I just got the timing wrong.
Yeah.
Exactly.
Sound like Steve Kane.
I'm right at some
That's
point.
right. Exactly.
If we just copy and paste this into 2024, I think it'll read perfectly.
Yeah.
But I mean, who had predicted this is the fastest pace of interest rate rises we've ever really seen? And I think who really knew the extent of the COVID stimulus response? We threw so much money at the country because there were economists talking about 15% unemployment rates. That would be disastrous for the country. So I think in many ways the government's response was appropriate. It's easier to sit back now and say it's too much, but because it perhaps was a little bit too much, inflation just went bananas.
Yeah, exactly.
Cate said we'll see an increase next monthly and maybe another increase if there's signs that inflation isn't easing, but agreed that she thought we would be under 3.1 by the end of the year. Gosh, I wish
Does that make us a bunch of optimists or what?
I don't know if you guys are necessarily. I think you're realists, but yeah, you did sound optimistic.
Yeah.
Dave said, I think we'll be around today where it'll be at the end of the year, we'll be about where we are today. So probably the closest. But then, the more you go on, the more specific you become, Dave. You're tying your own shoelaces together.
Yeah, there's a lesson in that for me, isn't there?
Yeah. But we've already recorded your 2024 predictions, so you'll have to remember
year.
Next year. You said we'll have 1, 2 at a stretch, maybe 3 more rate rises, and we'll have 1 to 3 reductions in the second half of the year. Again, timing.
Yeah. Yeah, well, Pete and I are good at just getting our predictions a year early. I think like with Perth, we've gone with Perth as the top performer a couple of years in a row. It's finally got there this year, Pete.
We'll be right sooner or later. More later than sooner, yes.
Yeah.
Eventually rates will drop, and hopefully soon. All right, let's talk rents and vacancy rates, because rents and vacancy rates have really been the big story of 2023. Rents have absolutely soared. I've had to remind people of your brilliant research, Pete, that rents have underperformed inflation over, what is it, a 26-year, 28-year period, I think?
Even shorter. You go 5 years, 10 years, and rents are still playing catch up, and they haven't caught up.
Yeah, exactly.
And I think that's an important thing to remind journalists, and I take every opportunity to do that. It's just the rapid pace of change that has made people hurt, but not dissimilar to the rapid change in interest rates, right? So it's not just renters that have suffered.
And inflation.
Inflation, absolutely. I've started looking at prices at the supermarket, right? Because I suppose there was a period of my younger life where I was poor and I was petrified of opening the mailbox lest there be a bill I couldn't afford. So when I didn't have to worry about money, I just ran around cavalier. I'm like, I want tomato sauce. I'm not going to look at the prices. This one looks the best on the label. And I've been doing that for years, right? But now I'm like, oh my gosh, like a Mars bar isn't $1.30 anymore. It's been a real shock.
You're showing your age there,
Just
Mike.
don't look.
I told my daughter, we went out to brunch on Sunday, and I told my daughter, you pick somewhere, all right? And so she picked somewhere. I didn't bother looking at the menu beforehand. I turn up, granola at $24. Are you kidding me? That's a dinner price, mate. Or that was the prices we were paying for dinner a few years ago.
Yeah.
Real.
Granola. You're limited to the amount of joy granola can bring you.
Exactly. That's $1.50 if you have it at home.
So, Cate, your prediction with rents, record increase in asking rents for 2023. Boom. That's a mic drop comment, surely. You said it'll shadow 2023. We're not getting more stock. We're getting more people. With interest rate increases, some people who are looking at purchasing might be renting in instead. First home buyers who want to move out of home might choose to rent as well.
Yeah.
Top marks, I've got to say.
Thanks,
A+.
Mike.
There's nothing really to say
Pete.
on that.
HD, Pete, yeah.
HD, good on you. Top of the class.
HT, yeah.
Pete.
Pete, HD to yourself as well. Rents will continue to increase at above average rate as overseas migration and international student numbers increase at an above average level. I don't think there's much to say on that one either. Top marks, HD. Dave, vacancies are so low already, they will stay around similar level. CBD of Melbourne and Sydney have come down from 10% to 3.2 and Melbourne right down to 2.5. We'll see similar levels, which is historically low. And you cited overseas migration. He said, I think Sydney and Melbourne in particular will see higher increases in rents. They're both more than 1% lower yielding than Brisbane, Adelaide, Canberra and Hobart. And then again, you've gone into so much detail that, I commend
thought we were
the
making
bravery.
actual predictions and not just vague statements. No.
Fair enough. Fair play to you. Rental increases across the country, the average will be about 5 to 8%. So you undercooked it a little bit.
I did, yeah.
But I think that's pretty impressive. And nationally, vacancy rates. We're talking in November 1.1%. It was 1% in November 22, the end of 2022. So
it slightly went up.
Yeah, but tight.
Yeah. And these are great charts. We'll pop them in the show notes, listeners.
Yeah.
Yes. So let's go to sales volumes. Cate, you predicted that we'll see more sales in 2023, listing numbers to be up as well. We had record low listing activity in the previous year, so that would have been 2022. Vendors seeing interest rate increases as a threat to their campaign. So once this stabilizes, again, maybe a timing thing, it's probably more stable now, we'll see vendors jumping in.
Yeah.
Now, before we go to the other two, we saw basically a 7.6% decrease in sales volume. So it was still a bad year for sales volumes. Pete was thinking they stay close to the 5-year average as the market goes back to normal. So i.e. no big increases or decreases in price. And Dave sort of echoed that statement around the 5-year average this year. First 6 months will be flat, but picking up in the back half of the year. I think it did pick up in the back half of the year.
I'd say Dave gets a gong there, and in defence of that, the data that we've got is only to November. We need to see December, Jan to really get that lag effect covered.
It'll come back a little bit, I think, yeah.
You can see on one of the charts, remember we had sort of the unseasonal pickup in around July, August, which stayed above the previous year until the end of the year. And in terms of, it was above the previous 5-year average across the whole year.
Yeah, totally. And above 2022. So, full marks to Dave because the data's showing that started in August, September.
And his extra little bit of detail that has sort of been giving him enough rope to hang himself on some of the other questions has finally come good for him. So, don't be afraid to throw it all out there, Dave.
Well, I think that's actually my shortest answer, so maybe there's something in there.
Less is more.
Yeah.
Risks that could impact the market. Starting with Pete, I can't see any major international or national events that will negatively impact our economy and therefore the residential property market. Now, we referenced this comment before. The commercial property market, especially office property, is a different story, ! Office property has suffered. There's no doubt about that, right?
Yeah, look, I do invest in office property as well, but through an unlisted trust it is. And I've seen the value come down and the dividends come down. I can't do much about that, but it's only a small amount of money. But some of my other friends have been invested in commercial property and their dividends have come way, way down. They haven't had to have it revalued, but and we haven't seen an immediate effect like we would in residential property, because typically residential property leases are 12 months, whereas commercial leases can be up to, say, typically 5 years. So if you signed a lease in 2019 or 2020, before COVID was really a thing, your lease is not coming up for renewal until this year or next year. So I think this year and next year, we will really see the full impact of COVID and office workers being able to work from home.
Yeah, and we've already dropped so far, so even more pain for that market. Cate, you sort of said that recession and higher unemployment is a risk that could be a wobble that would be unwelcome, but sort of there's a caveat to that. So far, unemployment rate has been stable and low, so we haven't suffered from unemployment. In fact, it's been record tight. But we did have. It's easy to forget now, but we did have recession talks in 2023.
Raising the unemployment rate talks that came directly from our new governor. And that was pretty frightening when you see someone prescribing something that will hurt a contingent of people.
And
I think it remains a threat.
Yeah, I think it's probably 1 year too early with that prediction.
Timing again. And we all know he said some other things that got him into a bit of trouble about interest rates as well. We covered that on a previous episode, the poor fella. Dave.
Only cost him his job, Mike.
Yeah, I know. But honestly, like for the money that this is a bit of an aside, but people get annoyed that, it's the highest paid public servant, or at least I remember it being so when Glenn Stevens was in office, and that was $1 million and you're a public servant on $1 million. I mean, these guys can get 5 times that in an afternoon by picking up the phone. It's a hard gig for the money, and I don't think he probably needs any. I think he'll be all right in his retirement. Dave, you've gone into some incredible detail here, and again, talking about Taiwan. There's a real military sort of bent to your predictions. Russia and Ukraine war, if that widened to involve other countries, that's a risk. We're actually kind of seeing the Israeli-Palestine widening to other countries. So it's a different conflict, obviously, but that is a future risk. You said there's a low likelihood of China invading Taiwan or some escalation of US-China relations. We probably sell a bit of simmering down of the South China Sea stuff, but the US and China have been somewhat friendly. Share market having a major correction, that's a risk. US and Eurozone entering recession. And here you go. That one little one, I think unemployment will rise. I guess it did in the back end of the year, but it was tight year for employment.
Yeah, I guess this question's an interesting one because it's saying risks which could impact the
Yes.
market as opposed to technically predictions. So, yeah, I guess I do comment on a bit of geopolitical stuff.
Oh, that's good. Keep it going. All right, inflation. Is this fair to finish on? I mean, this is going to seem like a hatchet job from me, right? Because I haven't really even read this, but I already sort of know it's gonna hurt a little bit.
Oh, one of us absolutely nailed it.
What-
And
Is
it
that
wasn't
right?
me.
Well, look, Pete's numbers are pretty much spot on
Yeah.
with where we finished up.
Yeah.
Yeah,
just
Well
read
below
it.
where it is today. It should be
4.9%
between.
today. So just got
yeah.
I
There you
think
go.
Magic, Pete. It should be between 4 and 5%.
well.
But that's
lucky.
now, Pete. Did you make comments prior to say that, you know, when the interest rates drop, the market will do X, Y, Z? But at the same time, you also predicted inflation to be quite high. So it sort of seems like you've answered that in two different kind of time frames. Talk us through that.
Well, I mean, there was a lot of uncertainty in the market. You know, I didn't think that interest rates would continue to go up as much. I mean, obviously, interest rates and inflation are very closely related. But I just thought, I mean, the main reason inflation went up is because of the Russia-Ukrainian conflict. And we are now, back then, it had been running for several months. And so to me, it didn't look like anyone else was going to get involved. So I thought probably the worst is over so far as inflation is concerned. But so far as interest rates are concerned, that was governed by the RBA. And so they just kept increasing and increasing based on the data that they were getting, obviously to try and bring inflation down. But I mean, you know, I'm not a genius. Nobody pays me $1 million a year to work this stuff out. But inflation is a yearly figure, right? So if you look at the first 6 months of that year compared to the last 6 months, it was obvious that inflation is on the way down. And if people go to the RBA website and check it out now, you can see that. You know, it doesn't take a genius to work out that our inflation will be lower at the end of this year than it is today, because the trend already is for it to be on the way down. Like, you're not trying to pick 1 month's inflation. These figures are over 1 year, and there's 12 points of data, and the trend is obviously down.
The trend is your friend.
Yeah. And I think if inflation is not down at the end of next year, there'll be pitchforks and torches at Martin Place and Parliament House. Well done on that one, Pete. Cate, your prediction was that when inflation does stabilise, it'll come down quickly. Supply chain issues compounded by events out of the control. When it comes down, it can happen very suddenly. So I think possibly a copy paste for 2024, right?
Yeah, I don't think we've seen sudden deflation at all. It's been a steady decline. Pete was right.
Dave suggested that it'll stabilise and fall back within the target range and possibly even below across the 12 months to the target range or a bit above. You know, I mean, that prediction is sort of more coming true now than in 2023, right? What do you rate yourself, Dave?
Yeah, look, not quite. Didn't nail it quite as much as Pete. I guess it depends if we're talking about the average across the 12 months or where it's at on a monthly basis. I can't remember whether I was predicting the average of the 12 months or where it would be at a monthly basis. But, you know, what are we at on the monthly basis? What was it in the last one? 4.3.
Good question.
4.9.
The monthly CPI in
4.9
over the year, was it?
Oh, no, that was the last reading over the year. 4.3 in the 12 months to November 2023. This time last year, the monthly CPI indicator rose 7.3% in the 12 months to November 2022.
Yeah, so I felt like it would be closer to 3%. So I thought it'd fall a bit further than it has.
All right, well, that brings us to the end of what was the glorious and not so glorious predictions of the buyer, the planner, and the professor for 2023. I think across the board, it showed how difficult it was to predict the year that was 2023, but also quite a few moments where the team nailed it. So fair play to all of you. To finish up today, let's go to the gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
All right, so talking from experience and theory, this is for the younger people that are listening. Borrow as much as you can, to buy as much as you can, and hold on for as long as you can.
I love that. The best advice is the most simple, right? Like people are looking for these crazy little loopholes and that sort of stuff, but I couldn't agree more. I think 2024, we're in for a good year. What about you, Dave?
I think it's exciting listening and reading when a bunch of people that are passionate about something and have some degree of experience in the field. I'm not suggesting that we're economists by any measure, but we've all got our expertise within this property industry. When we don't just agree with each other, when we're not looking at getting some broad consensus, we've kept this juicy, and in some of our answers we've been aligned, but in some of them we've been opposing each other. And I think it goes to show when you're looking at what economists are saying or what a collective of people are saying, if all of their outlooks are matching and looking very similar, you can probably anticipate that they'll be getting it wrong, because you can see what bits we got right and what bits we got horrendously wrong. And the stuff that we all broadly agreed on, we weren't necessarily on the money. So guys, I hope that we always stay fiercely independent, say what we really think, even if we're going to get it wrong, and admit it, because I think it makes for good listening.
Yeah. I love it. And I love the courage that you guys put in putting it out there, because, it was painful for some of that, I'm sure. And my gold nugget is avoid the predictions and just be the host and roast everyone else, because that's the easiest gig in the world. Well, on behalf of the property trio, it's a massive thank you to Peter for coming back. We were all very, very excited to hear that you were coming back to do this episode. And I know that everyone listening has been missing you. So thanks very much for joining us on the show.
Thank you very much for the invitation. I too was very excited to get back on and talk to you. It's been a wonderful episode, and I wish you all the best for the future. That's listeners.
Thank you very much.
Well as you three.
Thanks, Pete.
Great to have you back, Pete.
All right. Thanks, guys. That was a great episode, and we'll see you next week.
See you next week.
See you later, everyone.
Bye.